Well, welcome back to Finance Uncut. On today's episode, you must own silver. Billionaire investor Ray Dalio, if you don't own gold, you know neither history nor economics. So Ray Dalio is telling people to own gold right now. However, in this video, I'm going to explain why I believe you must own silver. Billionaire investor Ray Dalio says the US is on the wrong path after inflation hits a 31-year high. Billionaire hedge fund manager Ray Dalio has said the US is on the wrong path after inflation hit a 31-year high in October. Dalio posted a newsletter on LinkedIn warning that strong inflation is eroding people's wealth. He said people shouldn't be fooled into thinking they're getting richer just because their financial portfolios are going up. He had a stark warning for the US, saying it must focus spending on investment to boost productivity rather than to fuel consumption. The United States now is spending a lot more money than it's earning and paying for it by printing money that is being devalued. To improve, we have to raise productivity and cooperation. Right now, we are on the wrong path, Dalio said. Dalio founded the $150 billion hedge fund Bridgewater Associates and is its co-chief investment officer. He said the high level of inflation was a result of stimulus policies from the US government and Federal Reserve. At this time, 1, the government is printing a lot more money, 2, people are getting a lot more money, currency, and 3, that is producing a lot more buying, that is producing a lot more inflation, he wrote in the newsletter. Some people make the mistake of thinking that they are getting richer because they are seeing their assets go up in price, without seeing how their buying power is being eroded. The ones most hurt are those who have their money in cash, he added. Investors are normally very worried about inflation because it eats away at the value of their portfolios. For example, if an asset returns 3% in a year but inflation is 4%, the investor has lost 1% in real terms. Yet in recent weeks, the stock market has remained relatively buoyant, despite the surge in price levels. Many analysts say this is because real returns on bonds are at record lows, meaning there's no alternative to buying stocks. So we all know that we've got an inflation problem. The question is, what are central banks going to do about it? Well, yes, it's true that there's been a lot of speculation in the stock market and other markets. But what are the central banks going to do? Well, let's cut to a clip from a former president of the Fed and see what he has to say.
No one is owned economic history like the Richmond Fed back to 1912. And we're thrilled that Jeffrey Lacker could join us this morning. Jeff Lacker, we were talking in the comments there of Bill Dudley of Berkeley and, of course, of the New York Fed shifting, dare I say, Jeff, to the edge of Lacker. Does it surprise you to see moderates or even some doves approach a more cautious Richmond view?
It's certainly striking that a number of people that you would historically think of as on the dovish wing have come around to this. But in a way, it's not surprising. And I think it's because of how far out of bounds of historical pattern the Fed's reaction to this inflation surge has been. People forget that the reason we got inflation under control, tamed it, and then brought it down to 2% was by reacting with alacrity to inflation scares, little blips in the bond market that signaled the possibility of increased inflation expectations. Instead, this Fed seems to be willing to let it run.
Jeffrey, let's take it, Jeffrey, right now to the immediate debate at hand, and I do this in honor of Thomas Humphrey, of course, and all the history you've done. Paul Krugman has gone back to the history of 1947, the post-World War II spike. Down we came with massive disinflation, Eisenhower deflation, and then there's the late 60s, which was a little bit different. You basically suggest Mr. Krugman may be off and Mr. Lacker may be on with a more pernicious inflation of the late 60s. Discuss.
Well, I can see why the 47-48 episode is attractive for those who are sanguine about this surge. But for me, it seems like the 1960s and early 70s is the more apt comparison. inflation is ultimately about fiscal and monetary policy. And at that time period, you had two very significant shifts. A shift in fiscal policy with President Johnson running a Great Society program, but also running an escalation in the war in Vietnam that busted budgets. And then on the monetary policy side, you had the gradual and then sudden abandonment of the Bretton Woods system, which tied the value of the dollar, however loosely, but in the long run to gold and tied down longer run inflation expectations. In addition, you had the subservience of Fed Chairman William McChesney Martin and Arthur Burns to prevailing political winds, a subservience that tilted them in the direction of reducing unemployment and setting inflation pressures aside. Today, now we obviously have a very striking and large change in the fiscal outlook that's occurred over the last couple of years. And on the monetary policy side, the Fed rewrote its framework. It rewrote its philosophy last year. And again, it tilted towards a greater concern about employment and less of a concern about inflation, more of a willingness to let it run.
Jeff,
so
do you agree?
The parallels are striking.
Do you agree then that the remedy is going to be a very quick series of rate hikes, or perhaps a jump akin to what Bill Dudley was talking about, where we could get 3 to 4% end policy rates or peak policy rates in the cycle?
3 to 4% wouldn't surprise me in the cycle. I think they're on track to a major policy blunder, and recovering from that, realizing they've waited too long, is going to cause them to, of necessity, raise rates sharply and try and engineer a cooling of the labor market. And that very rarely turns out well. It's Bill Dudley's pointed this out publicly, that and others as well, that the Fed rarely is able to get the unemployment rate to go back up a little bit without it going up a fairly large amount. It's very hard to calibrate just how much to take out of the system. And it seems to me plausible that we get to 3.5%, 4%. And in addition, that we push the economy into a recession.
Well, there you go. You heard it from Jeff Lacker, who was the former Richmond Fed president. And he is looking at similarities with the late 60s and 1970s. And remember, if you go back there, Arthur Burns, who was the chairman of the Fed, was saying the same things Jerome Powell is saying now: transitory, transitory, transitory. And as Jeff said, they were focused on employment rather than inflation. And Jeff said there that he wouldn't be surprised. In fact, he's expecting in this rate cycle that we're going to see interest rates rise 3 to 4%, as Bill Dudley has said also. But before we have a look at why I think we must own silver, or you must own silver, and have a look at the 1970s, let's just cut to another clip from economist Stephen Roach, who worked on the research team at the Federal Reserve Board from 1972 to 1979. So, he knows all about what happened during that period. He was the one doing the research, and he was also chairman and chief economist at Morgan Stanley.
How worried are you about inflation at a time when consumer prices just continue to rise month over month?
Well, I'm very worried about inflation. I'm not in the transitory inflation camp. I learned the painful lessons of focusing on transitory special factors when I worked at the Fed in the early 70s, and that was a recipe for disaster. And what worries me the most, Seema, right now, is that the Fed today has really no institutional memory, no policymakers in the control room who've had any firsthand experience with the types of shocks that we're seeing right now. And, their first line of defense appears to be the balance sheet and the balance sheet tapering rather than going more aggressively at the policy interest rate. And I think they've got that backwards. I think they need to raise rates first and worry about the balance sheet later.
So that's when you look at the Fed's response so far to inflation, would you say that that's what worries you most, the way the central bank is approaching inflation?
Yeah, I think they're in denial. They continue to harbor the view that, these are transitory, COVID-related rebound effects, and we know that the supply chain is broken, and we also know that the level of aggregate demand is much, much stronger than the Fed had thought when assessing inflation prospects in its recent policy meetings. And so that supply-demand imbalance is going to be persistent, enduring. Okay,
so let's have a look at this. I also think that there's a lot of similarities between now and the 1970s. We are seeing a sick economy with a lot of inflation and high CPI, and that's what we saw in the 1970s as well. And let's just have a look at this. So if, as Jeff Lacker said, that we do see interest rates rising 3 or 4% in this cycle, now a lot of people will say automatically that that is bearish for gold and silver. That's going to be bad for gold and silver because all of a sudden, people stick their money in cash or in bonds and whatnot because they can get a yield. Well, once again, let's have a look at the 1970s. So on this chart right here, you can see between 1973 and 1974, silver in an 8-month period went up 144%. Now, what happened during that time period? We also had a recession. We had a stock market crash of 50% in nominal terms. And we'll have a look in a sec, but you'll see that silver after that pretty much traded sideways, between $4 and $6 for several years before, once again, in the late 70s, we had a 12-month period there where we had a big spike in silver, 743%, and gold had similar moves as well. Not as high in percentage terms, but gold had very similar moves as well. So when you look at this chart, the US 10-year real yield, okay, so you can see the two spikes into the negative real yield territory coincides with those moves in both gold and silver. And we've also go to just before the GFC, go have a look at, or during the GFC, and then that 2010-11 period, and silver moved in the same way as well as gold. And then obviously from last year, in March, we know what happened, and we saw the run in both gold and silver as well. The question is, where do interest rates and where do real yields go from here? Well, as we can see, in the 1970s, we had inflation, or CPI, rising. You can see in the middle there, during that 1973-74 period, 75 period, we had that recession. We had the stock market fall 50% in nominal terms. But yeah, you can see that the CPI rate in 74-75 hit, I think it was 1974, hit 12.5%. And so we had that negative real yield because interest rates were about 8%. But you can see earlier than that interest rates yields went from about 4%, 3.8%, 3.9%, up to 8%. So interest rates doubled, but CPI went up even more. And so we had that run up in silver during that period, while we had that stock market crash 50% in nominal terms. So yeah, interest rates rise 3 or 4%. That is going to be negative risk on assets. And so we're going to have a fall, I believe, in if central banks do raise rates, then we're going to have a fall in house prices. We're going to have a fall in the stock market, and I believe cryptocurrency as well, because we're going to go from risk on to risk off, and a lot of capital will then move into this space, because I also believe that we're going to continue to see CPI getting worse throughout this decade. CPI doesn't go up in a straight line, as you can see from this chart in the 1970s, but I believe even as rates do rise, and I think central banks will be slow and they'll react late. And I mean, they're already reacting late. So we're going to continue to see negative real yields. And yeah, so this can happen. A lot of people say, well, if the stock market falls and gold and silver are going to fall and crash, and look, they might pull back a little bit, but they didn't back here in the 1970s during this time period. In fact, they went up. They went up. They did well. But then the silver during that period from basically 1976 through to 1979, and we'll have a look at it in a sec, basically went sideways before that final big leg up. So I've shared this chart in other videos, and you can see here that from 1974 through to 76, that silver basically went sideways. So after it had its big run up during that time period, it basically went sideways, traded sideways since during that period. And then, as I said, what happened after that? And silver just went sideways until that big run up. And this is what I believe we're going to see again. Now, once again, that silver price ran up when interest rates went up very fast. So once again, when we go back to this chart, you can see that, well, rates came down, but then rates really started going up quite significantly in the late 70s, where they went higher than what it was in 1974-75. And yet we still saw that rise. And remember in I think it was 1978, there was concern about the US dollar, and we had Carter bonds, which were backed by the Swiss franc, because people were losing confidence in the US dollar. And so we'll probably see that again, and that's when you'll see the capital flows from the big institutions. And I've talked about this in other videos. When the big money, the institutional investors start pouring into gold and silver, then we're going to see these big spikes up once again. Now, just another reason to own silver. When you have a look at the mining ratio, which is around 8-to-1, investment supply around 4-to-1, yet the price is around 72-to-1 with the gold-silver ratio. To me, silver is undervalued on so many metrics. And as a value investor, I buy things. I look at the macro outlook, and obviously I see inflation, an inflationary decade ahead. And I see overpriced assets, and I see silver, which is undervalued on so many metrics, and this is just one. Now, I'm not saying that we're going to see the gold-silver ratio go to 8-to-1 or 4-to-1. I mean, it's possible, but I definitely think it'll come down. But I think gold is moving higher, and silver would just move higher at a lot faster pace, and so that price, that gold-silver ratio, is going to come down quite significantly. And I've shared this chart before on previous videos. So where can the gold-silver ratio go? Well, it depends on the gold price, depends where the gold-silver ratio is. So, if you think gold's going to $2,000 an ounce, which isn't much higher than where it's at, and the gold-silver ratio is going to 30, 20, then you can see $66 to $100 silver. If you think gold's going to $2,500, $3,000, and you think the gold-silver ratio is going to be around 20 or 30, I actually do think that we can see the gold-silver ratio somewhere between that 20 and 40 mark. I don't expect it to go to its mining ratio of 8-to-1. I'd love it to happen, but I definitely see the gold-silver ratio somewhere between 20 and 40 in the next couple of years, by probably 2023, but as I said, could be 2024. But I put these dates out these times. You guys can hold me to account on that. it may even happen earlier. Maybe even happen earlier. So, yeah, have a look at the gold price. Where do you think the gold price is going? Where do you think the gold-silver ratio is going? In my opinion, I think in the next couple of years, we're going to see gold between $3,000 and $5,000 an ounce. And therefore, if you have a look at that gold-silver ratio, then we could expect anywhere from $75 an ounce up to $250 an ounce. Now, as you guys know on this channel, I have talked about triple-digit silver, and my price target is that triple-digit silver. You ask me what it is exactly, I don't know. I think it's going to be somewhere between $100 and $200. But anyway, that's just my opinion. Anyway, guys, if you like this video, please hit that like button. Really do appreciate it. What do you guys think? Do you guys think you should own silver right now? I think the macro outlook is very obvious, in my opinion, and I think silver is the more undervalued metal out of the two, out of gold and silver. But love to see your thoughts and opinions in the comments below. Anyway, guys, take care, and I'll see you again on another episode of Finance Uncut.